So friends, ever wondered how a small shop and big company get the money to run? So in this video, I will explain what funds are, what financial management means, and the common form of business organization, starting with the simplest, that is the sole proprietor. So think of money for a business like a fuel for a car. You can think of business for a basically you can think of money for a business like a fuel for a car. Owner put in some fuel at the start, that is the owner capital. But as the business run, it need more fuel, right? So these are the two things. The first thing is called the fixed asset, and the second thing is called the working capital. You can see clearly written here: fixed asset and the working capital. More fuel is needed, right? So fixed asset means some big things, right, that you can keep for a long time. And working capital means small money which is needed every day to build a stock, to pay a staff, and to run the bill. So these are the things. Now, so owner money start the engine. Additional fund keep it running and growing. So this is how it works. Now, why is financial management? What is financial management? Let's understand it simple. So financial management is just a smart money handling for a business. What are the four steps of the financial management? Let's have a look. What are the four important steps? First of all, we plan. Basically, when I say planning, planning means deciding how much money you will need. So basically, we decide money, how much money you will need. Then organizing. Organizing means arrange where the money will come from. That is called, arrange money. Conducting. Conducting means, that actually use the money for asset, inventory, salary. That is called conducting. Means do. Okay, you use the money for asset, inventory, and salary. And finally, we control. Controlling means, check regularly so that you don't overspend. So it's like, planning a family trip. You estimate the cost, you collect the money, you spend them, and you keep the receipt. Right? So that is how the four-step process is. Plan, organize, do, and control. PDCA. Now, forms of the business. Basically here are the common form. The first is the sole proprietary. You know it very well. That one person own and run the business. Partnership, which means two or more people share ownership and responsibility. Limited liability partnerships. In short, we call it LLP. LLP means partner, but liability is limited. Hindu undivided family, which means, family run business under Hindu law. Then we have AOP, association of person or body of or body of it, or BOP, BOI. So a group formed for a common business purpose. That is called AOP and BOI. So pick the right form carefully. Changing the form later can create tax or legal consequences. Okay, but that is the point. So the choice of business organization should be made carefully. Now, let's zoom into the sole proprietorship, which is the simplest form. So, it is owned by, run by one person, which means, for example, your local grocery shop, which is owned by Mr. Sharma, local grocery shop. So he makes the decision, right? That is called, sole proprietor. Then the second point is no legal distinction between the owner and the firm, which means the business and the owner are the same in the eye of the law. If the business owns money, the owner personal money or property might be used to pay. That is the point. So no distinction. Suppose this particular business it owns money. So in that case, personal money can be used. Okay. Now, subject to the minimum regulation. Since starting is easy, fewer rule and paperwork than a company. And what are the limitation of a capital? Yes, capital limitation is there. Because only one person fund it. So money can be limited. That make growth harder unless the owner borrow or take partner. So pros is that, easy to start, all profit go to the owner, full control. But the cons is that unlimited personal liability, limited fund, and growth can be slow. Fund includes what? Fund includes owner's capital. Owner capital is fund. Plus it includes extra money. Okay. Extra money can be fixed asset or working capital both. Then I told you fixed asset is the long-term thing and working capital is the day-to-day cash. Financial management is plan, organize, do, and control. Form of business, I told you these are the different forms like sole proprietor, partnership, LLP, HUF, AOP, BOI. And sole proprietor means one owner, easy to start. Owner is the owner of business, owner and is equal to business legally, and limited capital, unlimited personal liability. What about the partnership form? Let's understand. So basically, every business need a shape, a legal form. The shape decide who run it, who pay if the things goes wrong, and how big it can grow. Right. Let's break the common business form into small, simple bites. Partnership form, what it is? It is an agreement between two or more people to run a business and to share the profit. So you can see association of two or more people. First point. Second point, why it exists? Because the people pool skill, money, and work together. For example, two friends opening a restaurant. Okay. So what they do? They pool money, right? They pool work together. They pool their skill. And one more point is that, the liability of each partner is unlimited. It means, the partner are personally responsible for the business debt. Okay, the business or money creator can go after the partner personal asset. That is called unlimited liability. It simply means, partners are responsible for the business debt. Just remember it. Partners are responsible for the business debt. Right. So that is called, unlimited liability. So if the business owes money, creator can go after partner personal asset. Also, there is a limit of the size. So generally up to 50%, and is the limit. Beyond that, business may need a different form. Now, legal status. The firm is not separate from the partner. Okay. The firm is not separate from the partner. Legally, the partner and the firm are the same. That is called no separate legal status from the partner. Maximum how much? Maximum are 50 people. Now, how formed a partner? See, basically by a partnership agreement or a contract, right? It can be formed. So basically, these are the points. So partnership is friend plus contract plus shared profit. But beware, your house could be at risk if the business fail. Now let's talk about the LLP, which is called limited liability partnership. So it is a modern form of partnership where partner get protection. Some or all partner have limited liability. Either some partner or all partner, they have the limited liability. That's the point. Now, one more point, it combined partnership flexibility and the limited liability feature of the company. It combined both the world, right? So it combined basically partnership flexibility is there. Okay. And plus limited liability feature of the company. Combine both of them. And it must be registered in India with the Ministry of Corporate Affairs. This gives it, it gives it formal legal identity, right? It must be registered with the Ministry of Corporate Affairs. Legal entity, LLP is a separate legal entity, which means the LLP debt belong to the LLP, not automatically to its partner. What about the partner protection? See, it means, that one partner is generally not personally liable for the wrongful act of the other partner, right? That is the point. Why choose LLP? It is good when you want a teamwork plus a protection. Right. So you can think of LLP as a partnership wearing a safety shield. You work together, but your personal assets are safer. The third case we have is Hindu undivided family. That is called HUF. So basically it is a family business form under Hindu law. The business is owned by the member of an undivided Hindu family. Okay. Who manages this HUF? So basically traditionally it is managed by Karta. Traditionally it is managed by Karta. Right. He is the senior most member and he acts like the manager. It is managed by Karta, who is the senior most member. Right. Purpose and the use. So it is used for running ancestral property, family shop or joint family investment. So you can see these are the use. So it is used for running the ancestral property, right? And family shop or joint family investment. What about the tax and identity? So HUF is treated as a distinct unit. Remember, this HUF, they are treated like a distinct unit. Okay, for some legal and tax purpose. So HUF is a family run business where the family own the business together and Karta usually leads it. Then we have AOP, right? We have AOP and BOI. AOP means association of person or BOI means body of individual. So it is a group of people which can be incorporated body or not. So group of people who come together for a common objective, not necessarily a formal partnership. So we're talking about the AOP or BOI. It is a group of people who come together for a common objective. So remember the keywords here. Let me highlight it. They come together for a common objective, right? Not necessarily a formal partnership. This is the keyword. Please remember it, right? And the next point is who can be the member? Member can be the natural person or it can be the artificial person. Like company trust can also be the member, and natural person means people can also be the member, right? I hope it is clear. Now, where it is used? So remember that it is common for club, informal investment group, or a consortium formed to do a project. Flexibility. It is very much flexible. The group right and the duties depends on the agreement that they make. So we can say AOP or BOY is a team formed for a purpose. Could be friend pooling fund or multiple firm joining, right? So these are the points. So let's quickly recapitulate what are the points which we have just discussed now. Quick recapitulation help you memorize the things for a long time. So let me do the quick recapitulation. So we started with the partnership firm. Remember, partnership firm are easy to form. Easy to form plus shared skill. We are talking about the partnership firm. But unlimited liability is there. Plus limited growth. What about LLP? LLP is limited liability plus separate legal identity. They need registration and some compliance is required. What about HUF? It is family control. It is simple for ancestral asset. It is limited to Hindu family member. What about the AOP and BOI? So AOP and BOI are flexible membership. Good for short-term project. Depends on the group agreement. So partnership 2+ people, agreement, share profit, unlimited liability up to 50 members and no separate legal identity. LLP partnership plus limited liability, registered, separate legal identity, partner personal asset usually protected. HUF means undivided Hindu family ownership managed by Karta and family unit. And AOP and BOI. This is the group formed for common objective. Now let's talk about the financial decision in a firm. So ever wondered how the business decide how much money to raise, where to get it from, which big project to spend it on? So I will explain financial decision in the simple word. Financial decision are simple choice. Simply choice about how much money a firm need and how to use it so that the business meet its goal. So basically you can think of financial decision as a choice about how much fund a business need, how to use it. Right, like growing sale, buying a machine, staying alive during slow month. So what are financial decision? So financial decision means two things: acquiring capital and utilizing capital. So friends, basically it means two things: acquiring capital and utilizing capital. Think that you are building a new bakery. You need money to buy an oven, right? So let me give you one example how the financial decision is taken. Suppose you are building a new bakery, right? So you will need what? You will need money to buy an oven. Yes, you will need money to buy an oven. Oven means a big purchase. And you need flour every day. You need flour every day. Flour means what? Daily money. So financial decision decide how much to raise and how to split spending between long-term thing and day-to-day needs. Then we have, estimated capital requirement, how to think about it. So we are talking about the capital requirement. Let's look at it. So we all know that, when we talk about the capital requirement, basically we list the fixed thing, like long-term thing, like machine, vehicle, building, major equipment, right? So first of all, we list the fixed thing, fixed asset. Then we list the working capital, like, short-term, raw material, wages, rent, utilities for a few months. And then add a safety margin, right? And then we add a safety margin for surprises like seasonalities and delays. And we align with the business objective. Okay. So we align with the business objective. Are you launching a small or scaling fast? The bigger the plan, the more capital you need. For example, bakery need a oven. Oven is a kind of fixed asset. 1 month of flour or staff pay. That is a working capital. And then little buffer for festival. Now let's talk about the debt and equity. So, firm usually mix debt. So when I say debt, it means borrowed money. And when I say equity, it means, that honored money. So fund mixes both of them, right? The mix matter because debt can give a boost to the honor return when the business earn more than the interest you pay. So now we are talking about debt. You know what debt does? Debt give you boost. Debt give a boost to the honor return, right? When the business earn more than the interest you pay. But too much debt make it hard to pay the interest and can threaten the survival. And too little debt can mean you miss chances to grow. So debt should neither be too much high or not too much low, right? Too much debt means, it is harder to pay interest. Let me give you a simple example to make it more clear. Right. Let's take one example. Suppose that project need 100 rupees. Project need 100 rupees and it earned 15%. So what is the return? 100 multiplied by 15%, which is rupees 15. This is the return. Now option number A. Option number A is, all equity means owner put rupees 100 in equity. Right. Owner put rupees 100 in equity. So what is the owner return? What is the owner return? So owner return is 15 upon 100, which is 15%. So again I am repeating. Project is 100 rupees and earn 15%. Return is 15 rupees. Owner, option number A, all equity means pura 100 rupees was in the form of equity. Okay. So what will the return? 15 upon 100, which will be 15%. Now option number B. Suppose you use 50%, 50 rupees as debt. Suppose you use 50 rupees as debt and you use 50 rupees as equity. Okay. And debt we use as 10% interest. So what is the interest on debt? Very simple. 50 multiplied by 10%. Interest will be how much? 50 multiplied by 10%, which will be how much? 5 rupees. What is the profit left for equity? See, profit left for equity is how much? 15 was the total profit. And how much profit is left? 10 rupees. Profit left is how much? 15 rupees minus 5 rupees, which is 10 rupees. This is the profit left for equity. Right. So what is the return on equity? So ROE will be 10 rupees upon initial investment, which is 50 rupees. So 20%. So you can see that debt increases the owner return. So now it is 20% instead of the earlier it was 15%. Right. So but the project only returned 8%. The effective return of the project is just 8%. Right. So profit is rupee 8 and interest is rupees 5. So equity get 3, equity return is 6%. So the takeaway is that, debt magnify the gain if project return are higher than the interest. It magnify the losses when return are lower than the interest. That is the point. That is what I went to tell you, that, debt magnify the interest rate. We can see with a high proportion of the debt potentially causing problem in the servicing debt and affecting viability. This is the point which I want to explain using this example. You see, in the second case, our debt become high, and since our debt become high, what happened? The gain become magnified. The gain is magnified, like 20% gain, right? Now let's talk about the source of the fund. So source of the fund can be, equity, which means owner's capital, which means money that owner put in, no fixed interest rate, but owner take the risk and receive profit. It is used when you want to permanent money base and can share control and profit. So the source of fund can be the equity. And preference share can also be one source. You can see now equity, preference share. What is the meaning of preference issue? You understand the preference issue? Basically, preference issue means hybrid like equity, but pay fixed dividend before ordinary shareholder. That's why they get the preference in their payment, right? They pay fixed dividend like ordinary holder. That's the point. And the next point that we have is public deposit, which means firms sometimes accept deposit from the public for fixed term, similar to borrowing from the many small lender. Then we have debenture or term loan. So debenture means formal borrowing in investment with fixed interest and repayment time. What about the debenture and the bonds? So these are the formal borrowing instrument with fixed interest and repayment plan. And what about the term loan? Term loan means what? Borrow from bank for deferred period with interest and repayment schedule. Then we have something called, weighted average cost of capital. So this is the firm average cost for the money that is used, weighing each source by how much it contribute. So in the weighted average cost of capital, there are various sources for funding a project. So we weight each and every firm. We weight, basically each source, right, by how much it contribute. The firm want to minimize the WACC because a lower average cost means more higher project profitability and increase the time. Now let's talk about the long-term investment decision. So, capital budgeting is choosing which big project to invest in. Yes, whenever I say capital budgeting, what it means, it means choosing that which project to invest in. That is called capital budgeting. Like buying a factory or launching a product. That is called capital budgeting. Which just means, choosing which project to invest. big project to invest, like buying a factory or launching a project. It is a long term because the money is tied up for a year. Common rule is that you use NPV, net present value, right? Then IRR, payback period, right? We have discussed already in all these things. So basically, let's quickly revise the key point which we have covered in the second slide. I told you that financial decision means acquiring plus using the capital fund to meet the objective. These two things, acquire it and use the capital fund. That's called financial decision. Then we have the estimate the capital requirement. So you have the fixed asset, you have the working capital, and plus some safety margin. Plus some safety margin is there. Debt versus equity, I told you. Debt can boost return but increases risk. So balance carefully. Then we talk about the sources of the fund, right? Like equity, preference share, public deposit, debenture, term loan. And we talk about the WACC, weighted average cost of capital. This is the average cost of fund. Objective is to minimize the WACC while staying safe. And capital budgeting means what we know. Capital budgeting means choosing. Now let's look at the objective of the financial management. So want to know how business choose the right project, grow smartly, and keep enough cash for day-to-day needs, and still keep the taxman and auditor happy. In this slide, I will explain the main objective of the financial management in the simple word. First of all, long-term investment. You can see the first keyword is long-term investment, which means, choosing big project or asset that a firm will keep, right, for years, like a factory, machine, or a major product launch. So that is called, long-term investment. So basically what we check, so does the project bring more money than it cost after adjusting for time and risk? This is the thing that we should look for, right? So does the project bring more money than it cost? See, there is something called the cost of the project, and the other hand, what it bring. So does the project bring more money than it cost after adjusting for time and after adjusting for the risk? This is the first thing that we check. There are some methods like, net present value. Like what is net present value? So you convert the future cash into today's money. If what you get back today's value is more than what you spend, it is good. Second method is called IRR, internal rate of return. So basically the percentage return that the project gives you, higher is the better. Third is called payback period. Payback period means how many years until you get your money back. Shorter is the safer. So think of it like, buying a vending machine. Will the coin it spits out every year be worth more than the price you paid today? Right. So that is what vending machine is all about. Now let's look at the corporate strategy. So what is the meaning of corporate strategy? Let's have a look. So basically, using money decision to help the firm grow, either by organic step. When I say organic step, it means, inside. So either you can grow by organic step, which means inside, or inorganic step. Inorganic means, buying and selling. That is called corporate strategy. So basically, you are using money decision to help the firm grow, either by organic step or by inorganic step. So let me give you some example of the organic step. Like, open new store, launch a product, hire sales people. So we are talking about the corporate strategy, which means using money decision to help the firm grow, either by organic step. Some example of organic step I have given you, like opening new store, like launching a product, like hiring the sales people. These are the organic step. And some inorganic step, like buy another company or merge. It saves time and it reduces the competition, right? These are the example of organic and inorganic mean. Why finance matter? Because money decide how fast, how safely. Money decide how fast and how safely you can grow. Wrong funding can slow you down or break you, right? That is the point. So these are the corporate strategy we're talking about. What about the working capital? Basically working capital management. What does it mean? It simply means, managing day-to-day cash need like a stock, receivable, payable, and cash on hand. So why balance matter? Because too little cash, you can't pay your bill. Obviously, you can think about it. If suppose you have little cash, so it means you cannot pay your bill. You cannot pay. And if too much idle cash, loss opportunity. So balance always matter. Okay, that is called working capital management. Too little cash, you cannot pay your bill. Too much cash, too much idle cash, you lost opportunity. Money could earn return elsewhere. So how to do it? So speed up collection from the customer, right? So to do it, you can speed up the collection from the customer, manage inventory so you don't overstock, negotiate longer payment term with the supplier, keep a small safe buffer for surprises. So working capital is like the kitchen cash for a restaurant. Keep enough to cook, but don't leave 1,000 unused under the table. right? I hope it is clear. Now we have the financial control. You know it, that continuous checking of financial performance and fixing what is wrong. We have some tools like ratio analysis, which is a quick health check like profit margin, debt ratio, etc. Then we have the costing. Costing means you should know how much each product or service cost to make. Then we have budgetary control. Budgetary control means what, you know, that set a plan, budget, and compare actual and correct the deviation. So it's like following a recipe, right? So checklist, financial control is like a measure performance and correct the error. Compliance. Compliance means make sure, right? So when I say compliance means what, you know, make sure that the company follow law and the rule about the account, audit, taxes, and disclosure. Why it matters? Because non-compliance can mean fine, legal trouble, loss of trust, which hurt businesses and shareholder, right? Like timely tax return, clean audit, correct public disclosure. So compliance is the business passport. Without it, you can't operate smoothly. So compliance means, you know, follow laws for account, audit, and tax. Then we have something called, you know, dividend or retained profit. Dividend versus retained profit and buyback. What to decide? Decide how much profit to give to shareholder now. Yes. So basically, dividend or retained profit, what to decide? You should decide how much profit to be given to the shareholder now. How much profit to be given to the shareholder now, dividend, and how much to keep for growth. So whatever profit you give to the shareholder, that is called dividend, and whatever profit you keep for growth, that is called, you know, that is called retained earning, RE, right? So basically these are the points. First of all, how much cash does the firm need for growth? Then, do shareholder prefer immediate cash or long-term value? Okay. Or will paying dividend hurt future project? You know what is the meaning of this buyback? So buyback, you know, company use cash to buy it on share. Like they can raise earning per share and they can reward, right? And reward shareholder, but you know, reduces the cash. So company use cash to buy it on share. They can raise earning per share and reward shareholder, but reduces cash. You can think of it like it. Split your cake, give slices to the guest, which is dividend, or keep and bake a bitter cake later. That is called retaining. Buyback is the company buying slice back from the guest. Buyback is like, you know, you give the guest your cake and you are buying it back from the. So friends, what we have talked just now, basically, you know, NPV, IRR, I told you, right? So long-term investment, you should pick project using NPV, IRR or payback method if you have long-term investment. That is the first point. Second point, I told you corporate strategy. You can grow organically, internal and inorganically, like merger and acquisition, like buying and selling, right? So basically, then we talked about the working capital management. So basically, working capital management means manage cash, inventory, receivable, and payable. Avoid idle cash. Then I talk you about, you know, financial control. So use ratio analysis, costing, and budgetary control. Then we have compliance. Follow rules for account, audit, tax, and disclosure. Then we have dividend and retained profit. Decide between paying shareholder now or funding growth. Buyback reduce share and can boost the shareholder value. Right? These are the points. Now, fundamental principle of finance. Let's understand it. So friends, want to make a smart money choice for a business without getting lost in jargon? In this slide, I will explain the fundamental principle of finance, simple with real life example. So, you know, finance is not magic. It is a set of common sense rule that help business get the right money. Use it wisely. Stay safe. Let's break down each principle into short bites so that you can remember them. So what are the objectives of the financial management? Let's have a look. You know, make sure that the business had the right amount of money at the right time at a reasonable cost for both short-term needs and the long-term plan. So, you know, think of it like keep the business funded, avoid expensive surprise, use money to grow profitably. What about the time value of money? So 100 rupees today is worth more than 100 rupees a year from now because you can invest today and earn. Right? So today money is like a seed. You can plant now. It grow. Tomorrow seed has not started growing yet. What is the meaning of this opportunity cost of money? Right? When I say opportunity cost of money, you know, choosing one option means giving up the next big option. The loss benefit is the opportunity cost. For example, let me give you one example to substantiate it. Suppose if you use rupees 10,000 to buy a machine, right? If you use rupees 10,000 to buy a machine, so you lose the chance to put that 10,000 in a fixed deposit earning interest. So every choice has a hidden cost, which what you did not choose. That is called opportunity cost. Then the next point we have risk and return, which means that higher potential return usually come with higher risk of loss, and lower risk option give a steady but a smaller return. Like a saving account is a low risk, low return. A stock may offer higher return but can fall sharply. So if you want higher reward, be ready to accept big swing. Then we have liquidity and return. You know it, that liquidity means how quickly you can turn an investment into cash without losing value. More liquid investment usually give lower return. This is the very, very important part. They are inversely proportional. If the investment is more liquid, so the return will be lower. Okay. For example, cash in the hand. Cash in hand is the most liquid, but earn little. Like a factory is illiquid, but many earn more. So liquidity is like having cash in your pocket versus money locked in a fixed deposit. Handy but high return. What about the diversification? Don't put all your egg in one basket. Spreading investment reduces the impact if one goes wrong. For example, if you sell shoes and also sell shirt, a bad season for shoes won't ruin your whole business. So diversity smooth out surprises. A few small losses can easier to handle than one big loss. And then we have, reducing the asset liability mismatch. Very, very important. So what is the meaning of this asset liability mismatch? Let me explain. Match the timing and the currency of what you own, that is called the asset, with what you owe. So you have to match the timing as well as the currency. These two words are the keyword. Timing plus currency. For example, if you borrow short term but buy a long term asset, you may face trouble when loan become due. Hedging reduces that mismatch. Hedging is a tool that reduces that mismatch. Then we have the cash flow. Cash flow is the money coming in and going out. Profit on paper are useless if you don't have cash to pay the bill. A shop may show profit, but if customer pay late, the shop might run out of the cash to buy the stock. Then you have to ensure the optimum utilization of the fund. This is the point. Optimum utilization of the fund, which means use funds so that every rupee work. Avoid idle cash or wasteful spending. And you have to make the sound capital investment decision. Right? Making the sound capital investment decision, which means choose long-term projects that add value using method that convert future cash into today's term, like NPV, IRR, payback, etc. Then we have to decide the optimum capital structure, which means find the right mix of debt and equity. Enough debt to boost return, but not much that interest payment choke the business. Ensure a statutory and regulatory compliance. Follow law for taxes, audit, disclosure, capital market. Non-compliance can lead to fine, legal trouble, and loss of trust. And finally, balance between shareholder benefit and the organization objective, which means give shareholder fair return like dividend or buyback while keeping enough fund to run the business or the financial growth. Then ensure appropriate risk management system. Have policies, checks, insurance, control to spot and manage the financial risk. Limit your exposure, use insurance, use hedges, perform regular audit, and have clear approval rule. So these are the points, right? So what I told you, what is the goal? The goal is to adequate and timely fund at the reasonable cost. That is the goal. Goal to have the adequate return at the timely. That is the goal. Time value money means rupee today is larger than the rupee tomorrow. Opportunity cost means you lose benefit of the next best option. Risk and return, I told you, more return, more risk. Quick cash, lower return. Liquidity and return trade-off. Quick cash, lower return. Diversification means a spread across asset to lower the risk. Asset liability mismatch. Match timing and currency of the asset and liability. Cash flow. We should monitor inflow and outflow. Profit is not cash. Diversification. Right. These points we have just discussed. Now let's look at the building block of the modern finance. So what is the building block? First is the diversification. So one, the simple rule that a smart business follow to handle money. So basically in the next few minutes, I will explain the key principle to the modern finance. So modern finance rests on few building blocks. First is the diversification. So I think we have discussed it. Suppose a farmer is there. He grow only mangoes and a blight hit mango tree. He loses everything. If he grow mangoes, wheat, vegetables, one bad crop won't ruin him. So diversify means many small risks are easier to survive than one big risk. Many small risks, they are easier to survive than one big risk. Then the asset liability mismatch, I think we discussed it. Cash flow principle. What is this cash flow principle? That watch the real cash coming in and going out, and when evaluating future cash, convert into today's value. This is called discounting. Here you will see the word discounting. Discounting means converting the future cash to today's value. That is called discounting. Why discounting? Because 100 rupees next year is worth less than 100 rupees today. So future cash must be reduced to a present value before deciding it. Right? That is called discounting. That is called cash flow principle. So they are the four building blocks of the modern principle. This is planning. You can see this four building block. Planning, decision making, organizing, directing, and finally controlling. Right? Let me highlight it. So first of all, planning. Planning means map out the capital need and the profit for short term and the long term. Right? So when I say planning means we map out the capital need. Right? We map out the capital need and the profits. We also map out the profit for short term and long term. Like budget, how much to spend on a new plant versus daily running cost. So planning is your roadmap. Where do you want to go? How much fuel you need? Then the second point we have is decision making. After planning, we have something called decision making. Decision making means what? Test whether the plan is viable, which investment to pick, where to get money, how much profit to retain or distribute. Like choosing project A, which have higher return, than project B, which is better. Then the third process we have is organizing and directing. So what does it mean? It simply means build team, build system and leadership to implement decision, put process, people and approval in place. Like hiring a project manager, set procurement rule, assign budget, etc. The next we have is controlling. Controlling means what? That monitor progress, compare actual versus plan, and correct course using budget, record and report. So plan, decide, organize, control. It's like a cycle. Plan, choose, do, act. PDCA. You remember it? And repeat. So we are talking about diversification, asset liability mismatch, cash flow. We should always keep inflow larger than the outflow. Planning, decision making, organizing. Organizing means building capability and lead the execution. And controlling is budget, record, report, spot deviation and correct it. Now friends, let's talk about the agency problem. Who look after a business when the owner is not around? And what happens when they don't share the same goal? In this slide, I will explain agency problem, stakeholder thinking, and business ethics in the simplest way. First of all, who is an agent? Agent is someone hired to act for someone else. He is someone who is hired to act for someone else. For example, owner, right? For example, take the case of owner. So owner, which means the shareholder. He hired manager. Owner hired the manager to run the company. Okay. So manager are the agent. So these manager, they are the agent. So owner hire shareholder, owner hire manager to run the company, manager are the agent. Like a homeowner hire a contractor. So the contractor is an agent. Agent means someone hired to act for someone else. Like manager is hired for the company, for the behalf of the owner. Now the question is, why do we use agent? So different people have different skill, different time, different access. So owner may not know how to run day-to-day operation or may not have time. So they hire expert. Right? That is the point. Now the question is, why do conflict happen? Different goal, information gap, different risk appetite. These are the reasons. Next of agent, right? So owner often can't do everything. So agent help them, but that create a new challenge and their goal may not match the owner. So why do conflict happen? So let's talk about the theories of the conflict of interest. So first of all, the conflict happened because of the different goal. You can see different goals are there. So owner want profit. Agent may want job security, perk or a study routine. So this one cause conflict. Okay. Second is the information gap. Information gap, which means basically agent often know more about the daily matters. Owner can't watch everything. That is called information gap. And third is the different risk appetite. Third reason can be, different risk appetite, which means agent may avoid risky project that could harm their job, even if the project is good for the shareholder. Let me give you one example. Take the case of parent, right? You can think of the parent like an owner. The parent hire a babysitter. Suppose a parent hire a babysitter. So this babysitter is an agent. Okay. If the babysitter prefer quiet evening, they might turn off activities the child enjoy. So their goal differ. So this causes conflict of interest. You can see now there is a separation of ownership. There is a separation in the management in the business. Because of this, conflict of interest arise. Now let's look at the types of agency problem with simple example. So first of all, shareholder versus management. So manager may prefer safe project or take perks like company car, big offices instead of the project that boosts the shareholder value. So this is one of the kind of it. Like you can see shareholder versus management. Just for example, like suppose CEO, right, chief executive officer, he delays a risky expansion that could raise profit because it may fail and threaten their job. Then we have the shareholder versus bondholder creditor. This is also kind of conflict of interest. Basically shareholder who is the equity owner may favor risky project that increase equity return but put creditor at risk. Obviously, it will put the bondholder and creditor at risk because creditor get paid first if things goes wrong, right? Then controlling stakeholder versus minority shareholder. A big owner may make deals that benefit their other business at the expense of a small shareholder. Then we have, shareholder versus other shareholder. With like, for example, let's take one example. So basically, owner aiming to cut cost might reduce staff or ignore environmental safety, hurting employee or the community, right? So conflict can be between owner and manager, owner and lender, big owner and small owner and other affected by the business. Now the question is how to mitigate it, how to reduce the agency problem. Simple, practical step. First of all, transparency. That clear and regular reporting, right? So that the owner and the public can see what the manager is doing, like financial report, performance update, etc. Then we have a stronger board and independent director. A stronger board and independent director, which means a watchful board help check manager decision. Then, pay link to the performance, linking compensation to the gain of principal, which means, like bonuses, stock option, profit sharing, that tie manager reward to the owner gain. Then contract and covenant, which means contract and covenant means loan covenant, employment contract, clear rule to limit the risky behavior. Then some audit is also done. Audit is done another way, right? So audit and internal control, whistleblower rules and ethical policies, shareholder right and activism. So these are the things. Now there are two theory. One is called agency theory. Another is called, stakeholder theory. See, what is the difference? Agency theory focus on the conflict between the principal, right? The conflict between the principal and the agent. What is the meaning of principal? So principal means the owner. And what is the meaning of agent? Agent means the manager. So agency theory focus on the conflict between these two entities. One is called principal, other is called agent, right? It asks how do we align manager action with the owner goal. What is the stakeholder theory? It is quite broad. It says that business should consider all group affected by the decision, right? It says that business should consider all the group who are affected by the decision, clearly written, within and outside the organization, who are affected by the decision. It could be employee, customer, supplier, community, regulator, and owner. So you can think of agency theory like parent and babysitter problem, and the stakeholder theory like deciding how a family decision affect the neighbor, school, and extended family too. So stakeholder theory says that business should consider all the group affected by the decision, and agency theory focuses on just the principal and the agent. That's it. And stakeholder theory look at the holistic approach. Now, why stakeholder matter? Very good question. The mission connection. That is, this is the mission of the organization. Very, very important. That the organization mission is better fulfilled when the collective interests of the stakeholder are considered. Right. A decision that helps shareholder but destroy customer trust or harm employee may hurt the company. So identify the key stakeholder, weigh their need, balance short-term profit with long-term reputation and sustainability. So good decisions don't merely make money today. They keep customer, employee, and the community on board for tomorrow.